All right, today we're diving into Tecan Group, a Swiss powerhouse in laboratory automation. Now, after a couple of tough years, its stock has really taken a hit, and that begs a huge question for any investor. Is this a truly high-quality company that's just on sale right now, or are its problems more serious than they look? To figure that out, we've got to understand the hidden engine that's driving so much of modern medicine.
We hear about these amazing breakthroughs all the time: gene editing, new cancer drugs, rapid diagnostics. But what we don't see is the quiet humming machinery in the background making it all possible. In thousands of labs across the globe, that engine is precision robotics, doing these incredibly complex and repetitive tasks over and over with an accuracy humans just can't match.
And Tecan, they are a massive player in that world. For years, this company was an absolute market darling. But lately, the story's flipped. Sales have dipped, and the stock price has followed them down. So the big question for us is, are we looking at a temporary stumble for a fantastic business, or is this a sign of some deeper cracks in the foundation?
To really get why this could be an opportunity, we first have to understand why investors have historically been willing to pay a premium price for Tecan stock. And it all comes down to a business model that's built on two really powerful competitive advantages, or as investors like to call them, moat. Okay, so here's how it works. On one side, you've got their life sciences business. This is where they sell their own Tecan-branded, high-tech liquid-handling robots straight to research labs. But then, on the other side, and this is super clever, they have what they call the partnering business. Here, they're basically the secret weapon for other huge diagnostic companies, building the complex robotic guts that go inside those companies' machines. So what's so great about that life sciences side? Well, it's this classic business model. They sell you the big, expensive machine, that's the razor, and that one sale basically locks the customer into buying high-margin, proprietary stuff like special pipette tips and service contracts for years and years. Those are the blades. And that creates this beautiful, steady, and really predictable stream of income. And you can see this strategy playing out perfectly right here. Just look at that growth. Back in 2017, recurring revenue was about 42% of their life sciences business. Fast forward to the first half of 2025, and that number is expected to hit over 62%. I mean, this fundamentally changes the quality of their earnings, making them way more stable and predictable, which investors absolutely love. Now, for the second moat, that comes from the partnering business. You should think of it like Intel Inside, but for the diagnostics world. See, once a giant company like a Siemens or a Thermo Fisher designs a Tecan system into their product, and, this is key, gets it all approved by regulators, the cost and the headache of trying to switch to someone else is just enormous. It creates these incredibly sticky long-term relationships. They're locked in. So, if the business model is so darn strong, what went wrong? Well, like a lot of companies in this space, Telecom is dealing with a really severe hangover from the COVID-19 pandemic, and you can see the impact written all over their financial statements. Yeah, the story here is pretty stark. After peaking back in 2022, sales fell off, not just in 2023, but again in 2024. And at the exact same time, their profitability, what we're looking at here with the EBITDA margin, it took a real hit, dropping from over 20% down to under 18%. This is exactly the kind of thing that spooks the market and sends investors running. But, and this is a really important but, here's where things get interesting. Even as their sales and profits were falling, the underlying financial engine of the company stayed incredibly strong. In 2024, they hit a perfect 100% cash conversion rate. That means for every single dollar of accounting profit, they generated a dollar of actual real operating cash. For an investor, that's a huge sign of quality. It tells you the earnings are real, and this business is a true cash-generating machine, not just profitable on paper. So what caused that downturn? It was basically a perfect storm of things happening all at once. The massive drop-off in COVID testing was the biggest factor, for sure. But on top of that, they were fighting a super strong Swiss franc, which hurts their international sales numbers, plus global inflation, a temporary slowdown in spending from their pharma customers, and a weaker market in China. Now, facing all those headwinds, management didn't just sit on their hands. They put a very clear, multi-part plan into action to get through the storm and get the company back on a path to profitable growth. So let's take a look at their playbook. The plan has three main parts. First, they're tightening their belts, optimizing operations, and consolidating facilities to get more efficient. Second, and this is a big one, they brought in a new CEO, Monica Manaudis, who spent more than 2 decades at Thermo Fisher, which is the undisputed heavyweight champion of this industry. That move sends a huge signal.
And third, they're doubling down on the fastest growing areas of the market, like genomics, and pushing to sell more directly in Asia. And they're not stopping the innovation either. This is a great example. Their new Vea workstation isn't just another robot. It's designed from the ground up to be way easier to use. The whole goal is to democratize automation, to make this powerful tech accessible to thousands of smaller labs that always found it too complicated before. I mean, that's how you grow your market.
Okay, so what do we have? We have a high-quality business model that's facing some temporary headwinds, but with a clear plan for a rebound. Which brings us to the final, and let's be honest, the most important question for any investor: what's the price for this opportunity, and what are the risks?
You know, the valuation tells the story perfectly. If you look at its depressed earnings from the past year, the stock looks kind of pricey with a PE ratio around 35. But if you look forward at what analysts think it's going to earn in the next year, that PE ratio drops all the way to around 22. That big gap means the market is already betting on a strong recovery. It's what we call a show-me story. The valuation makes sense if the new CEO and her team can actually deliver on their comeback plan. But of course, there are no guarantees, right? The risks are very real. R&D spending from their customers can go up and down. A huge chunk of their partnering revenue comes from just a handful of big clients, which is always a risk. That strong Swiss franc is a constant headache. And there's always the chance a big acquisition doesn't go as smoothly as you'd hope. These are the things you have to weigh.
Still, you have to look at what management is doing. They're signaling a ton of confidence. First, they kept paying the dividend, even when earnings dropped. That's a clear message that they think this downturn is just temporary. And second, they just announced a massive new share buyback program. Companies only do that when they believe their own stock is cheap and they're confident they'll have plenty of cash coming in.
So that's the bottom line. You've got this proven, high-quality business with really strong competitive moats. It's been through a rough patch, no doubt, but it has a clear plan to recover and new leadership from the best in the business. The market is already pricing in a comeback, but if they pull it off, there could still be a lot of upside. The question you have to ask yourself as an investor is simple. Do you believe they can deliver?